Welcome. Sometimes new mobile phones and laptops come with functions that are never used. Sometimes they don't do the things that are most needed. The same goes for legal models. Before choosing one, you'll need to have some idea about its functions, features, and capabilities. Businesses can be for-profit or not-for-profit. Australia's tax laws highlight this important choice. Some say that not-for-profits cannot make a profit. That's a myth. All businesses, including not-for-profits, should aim to profit from their activities. Otherwise, they soon become insolvent and must be wound up. Not-for-profit simply means that any profit made by the business must be devoted to the business purpose. It cannot be distributed to members of the co-op either during its trading or at the end of its life. There are two types of co-ops in Australia. Those that cannot distribute profits to members are non-distributing, not-for-profit co-ops. Distributing co-ops, as the name suggests, can distribute profits to their members. They are treated like other for-profit models, such as companies with share capital. An entity's constitution will state whether it can or cannot distribute profits. Sometimes, legislation also covers profit distribution. Incorporated associations, companies limited by guarantee, and non-distributing co-ops are all not-for-profits. They cannot distribute profits or assets to members, not while trading and not when the business is wound up. Not-for-profits are often thought of as charities, social or sporting groups, and community services. But restricting profit distribution doesn't mean that farmers can't get other benefits. Let's look at some examples. Bundaberg Fruit and Vegetable Growers is a non-distributing co-op promoting growers in Bundaberg, Queensland. It offers workshops, access to networks, training, event promotion, research and representation with government agencies. The Almond Board of Australia is a South Australian incorporated association that coordinates a national conference, distributes information, conducts field days and provides access to data. The Australian Macadamia Society is a company limited by guarantee which helps farmers understand food quality and pest control standards. It researches soil health, orchard management and crop forecasting and helps promote new products into export markets. Australia's largest grain exporter is a non-distributing co-op. The Cooperative Bulk Handling Group, CBH, is a consolidated group of entities under the umbrella of a non-distributing co-op, working to advance Australian grain growers. These not-for-profits help members to pool resources and develop better production, education, information and advocacy. They help to establish and improve supply chains through bulk purchase discounts, freight sharing and joint marketing. So you see, not-for-profit does not mean small. Not-for-profits must focus on being successful businesses. So how do you finance a not-for-profit? All not-for-profit businesses need start-up and ongoing funding to deliver benefits to members. Each not-for-profit model can rely on member fees. These can be set fees or variable levies determined by member type or capacity. A levy assumes that member benefits increase with higher contribution or volume of transactions. Not-for-profits can also borrow from banks or financiers. Bank loan terms are based on the organisation's balance sheet and cash flow projections. Some not-for-profits obtain grant funding, but this may not be a reliable source of income. Only co-ops have share capital, which can be used to raise finance from members. Despite not carrying a dividend, shares in a non-distributing co-op represent an asset owned by members, which can improve the co-op's balance sheet. Both co-ops and companies limited by guarantee can borrow from the public through debt securities. Co-ops can also issue cooperative capital units, or CCUs. Each type of not-for-profit can trade with their members by selling them discounted or bulk goods and services. Incorporated associations have restricted trade in some states because their governance laws are not suitable for larger operations. Associations can operate nationally if they have dual registration under the Corporations Act. They are referred to as Australian registrable bodies. Companies have national registration, and co-ops under the Cooperatives National Law can also operate nationally. For profit or not? That's the question. To answer that question, it's important to choose a co-op model that suits the proposed business. For farmers wanting to develop and promote a strong local brand, a non-distributing co-op may have the necessary features. This model not only serves current needs, but can provide a legacy for future farmers. Prohibiting profit distribution makes sense here because members want their annual fees to achieve the current marketing objectives and protect the future of the brand. Many regions in Australia have developed enduring brands. A non-distributing co-op secures these brand assets for local industries and communities. If the co-op is wound up, the no distribution clause means that any remaining value or brand assets devolve to another entity to continue that purpose. But non-distributing co-ops aren't just about branding. For example, Colliambly Irrigation Mutual is a non-distributing co-op created to manage and maintain irrigation infrastructure in that region. Colliambly holds substantial assets, including a fund for upgrades and maintenance to ensure the legacy of crucial infrastructure. Another example, Cooperative Bulk Handling, is a non-distributing co-op which holds extensive infrastructure to deliver transport, processing and marketing services for current and future grain farming communities. As the name suggests, a distributing co-op can distribute profits to members. These for-profit organisations are better described as for-purpose because they focus on serving members. Only active members who transact with the co-op can hold shares, and there are no external investor shareholders. Companies strive to maximise profit for shareholders. They prioritise profitable projects and abandon poor performers. By contrast, a co-op's purpose is providing the goods and services its members need. Each service might not turn a profit, but while they can make individual farmer businesses more profitable, they may still be provided. This doesn't mean that co-ops are designed to make losses. Their business must be profitable overall. The focus on member services ensures that members continue to use and value the co-op. This commitment to members and distributing trading profits only to members means the purpose is effectively ring-fenced. Non-distributing co-ops protect their purpose by prohibiting distributions. Distributing co-ops protect their purpose by delivering value to members who use it and own it. Share ownership restrictions and distribution methods reinforce the co-op's purpose and can impact strategy. A distributing co-op distributes profit differently from companies. Rebates are based on the amount of business done by a member. This encourages more transactions and helps business growth. A co-op can also pay bonus shares, again based on member transaction volume. This saves the co-op from distributing cash and builds up a member's capital. Another option is dividends on shares. Dividends encourage members to retain and grow their capital in the co-op, adding to its strength. Distributions can affect taxation, but more on that later. The choice of a non-distributing or distributing co-op is not simple. A good idea is to consider the co-op's primary activities. If the purpose or primary activity is restricted to marketing or branding, research and development, or industry advocacy, a non-distributing co-op may be sufficient. However, if the purposes are broader and include buying and selling member products, processing or value adding to products, or bulk purchasing on behalf of members, then a distributing cooperative may better serve the members. You might think you should choose the model with the most possibilities, or you might worry whether you've made the wrong choice. Don't panic. It is possible to change the co-op type later and ensure that existing members' rights are protected. Don't be tempted to choose the biggest with all the bells and whistles. It may be more than you need. You should make your choice based on your co-op's current purpose and primary activities, without trying to guess what may happen in the future. Often, new farmer groups need to learn about each other and how to work together before committing to a broad range of functions. But sometimes, planning broad functionality in the beginning may be a good strategy. Once established and operating, the co-op can incorporate other entities, like a company or a trust, to act as separate businesses, owned by or associated with the cooperative. For example, CBH is actually a group of entities owned by or associated with the parent co-op. Remember that a cooperative is democratically owned and controlled by its members. The co-op can own a company or set up and manage a trust, but the co-op cannot be owned or controlled by another entity. Again, these are matters for the future. When you're starting out, try to keep it simple. Incorporated associations, companies and co-ops are all corporations. They pay a single tax rate, and there is no tax-free threshold. Tax laws treat all corporations in the same way, unless they are not-for-profit. Now, some say that not-for-profits don't pay tax. That's a myth. Not-for-profit corporations must pay tax on assessable income, unless they have tax-exempt status. Charities, educational and health bodies can be granted tax exemption if they serve the public good. In practice, many not-for-profits don't pay tax, not because they're tax-exempt, but because they've not made a profit during the year, or their income or part of it is not assessable. So, what is taxable? A corporation pays tax on any assessable income in a financial year, less allowable deductions. Tax-exempt status is available for charities and also for not-for-profits doing research and development in agriculture if their main purpose is to promote resource development. Some income is not assessable. For example, some not-for-profits receive mutual income, which is not taxable. Tax-exempt status is available for not-for-profits which have as their primary purpose promotion of resource development. This means looking after or developing natural resources for broad public benefit. Some farming, fishing and forestry non-profits do just that. For example, a non-distributing agricultural co-op formed to do research, resource improvement, education and perhaps advocacy may qualify for tax-exempt status. Or a co-op could incorporate a separate not-for-profit to do this work and isolate some funds in this tax-exempt entity. Exemption is a self-assessment process managed by the tax office. A non-distributing co-op providing bulk buying or joint marketing is not a resource development purpose because it does not have a broad public benefit. Mutual income is not assessable income. The mutuality principle means that entities cannot earn income from themselves. Club member fees, for example, are mutual, but income the club gets from visitors is not. Let's try another example. A group of friends put money in to buy and share a car. The benefit each person receives is mutual. It benefits the group and the individuals. Let's say this group forms a not-for-profit, a separate entity to fairly manage a fund for the car, petrol and maintenance. The money paid in is not assessable because it is mutual. It is not from the sale of goods or services, but from member contributions. But If the members offered the car as an Uber to make extra money, that would not be mutual income. It would be taxable. A useful example of mutual income is a non-distributing co-op formed to hold and manage infrastructure for members' collective use. Members of the Colliambly Irrigation Mutual Co-op pay fees for the maintenance and renewal of irrigation for their collective benefit. These fees are mutual income, not taxable. That's a lot to remember, and we haven't even looked at deductions, grant income, or other tax incentives. These would need specifically tailored professional tax advice. So let's recap generally. Unless the non-distributing co-op has tax-exempt status or its income is classed as mutual income, it will pay tax on profits. So what about tax and for-profit distributing co-ops? Distributing co-ops are treated like companies. Both are corporations and pay tax on assessable income at the same rate. But this could get confusing, so stick with me here. Australian tax law does not distinguish between companies and cooperatives. Instead, the Tax Act makes special rules for cooperative companies. This is not a new legal model. It may be a co-op or a company, but for tax purposes, it must have particular characteristics. Cooperative companies are corporations that have limits on shareholdings, which means that an individual shareholder cannot hold a majority of shares in the entity. The shares, which may be traded privately, cannot be traded on a stock exchange. The corporation trades in products and services on behalf of members, and it does at least 90% of its business with members. These characteristics are common in the co-op sector. A distributing co-op that provides agricultural services to members is likely to meet the definition of a cooperative company. Cooperative companies can elect to pay tax either before or after profit distribution to members. This means it can choose to pay tax before profit distribution, so the tax is paid at entity level, or after profit distribution, so the tax is paid by the member on the distribution they receive. This is important to understand. Companies only pay dividends from after-tax profit. To ensure tax is only paid once on these profits, the dividends carry a franking credit, representing the amount of tax paid on that dividend. Shareholders claim the franking credits to obtain a personal tax rebate of the tax already paid by the company. When a company pays tax and issues franked dividends, this is paying tax at the entity level and at the corporate tax rate. Cooperative companies can elect to distribute rebates, dividends and bonuses to members and deduct these from assessable income before tax. This reduces the cooperative company's net profit and tax liability. Members who receive these untaxed distributions must then pay the tax in their individual tax returns. This shifts the tax burden to the members, so that tax on this part of the profit is paid at member level. This shift of the tax burden to members is an effective tax reduction method for the cooperative company, but it is not necessarily problematic for members, because each member will have different tax rates and status. Some members will prefer the larger rebates or dividends from these pre-tax profit distributions. There is more for cooperative companies. Under rules introduced in the 1930s to facilitate regional development, there are special tax deductions for producer cooperatives to acquire or construct infrastructure. Some state and territory governments also provide loan funds for this purpose. A cooperative company with a government loan for capital assets may deduct both interest and principal repayments from assessable income. Some large agricultural cooperatives have used this deduction to build infrastructure. For a co-op with limited access to capital, this assistance for major capital expenses provides broad benefits to local communities. In this module, we covered the nature of co-ops as for-purpose legal models in a tax environment focused on corporations as not-for-profit or for-profit. For-purpose co-ops do more than make profits. They are formed to serve their members wanting to collaborate, build and improve their businesses. Cooperatives have a proud history in Australia. They helped establish our agriculture and fishing industries. Co-ops build trust and stability in their communities and offer a sustainable business model. They create opportunities to share costs and resources in a competitive market. As member-focused and democratic organisations, co-ops help individuals to better determine their economic future. Knowing how co-ops work helps farmers to create the business functions and governance documents they need. The co-op sectors in Europe, Canada and the US are major components of those economies, bringing diversity and stability during the economic ups and downs that affect investor-owned companies. It is no surprise that the United Nations recognises co-ops as enterprises which improve lives and contribute to communities and to nations.